We're at the IBCA conclave here in Mumbai, and I'm joined by Karthik Reddy. He is the co-founder of Blume Ventures as well as the chairperson of the IBCA. Thanks so much, Karthik, for taking time out. First interview of the day. I just want to start off by sort of laying the groundwork in terms of the private capital flows that are coming in. 2023 has been a muted year. On what factors do you see it going up now in 2024?
So there are two ways to calibrate private capital flows. One is what actually gets invested, so which comes out of dry powder that managers like us have already raised. The second is what's being committed to fund managers. So we had a lot of dry powder, but people were very tentative. And a lot of cross-border global pools went very slow in 23. But you know, when we actually went and did the analysis, if you strip out the crazy years of 21 and 22, the numbers are not way off, let's say, 19 and 20. So essentially, what created the spike has gone away, but the consistency in terms of growth's been there. It's flat. It hasn't spiked, but I think 23 was meant to be that kind of a year. So 24, we're more optimistic on two counts. One, I think, it's like the proverbial wheat separating from the chaff. So all the problem cases are getting surfaced, they're getting addressed, some might die, some might go bankrupt, some might get down rounds, but they'll fix themselves. And I think we're in the final phase of that. So what didn't get cleaned in 23 will get done in 24. This is my take. That's and then when that happens, at least in venture, it clears the air, and people know what exactly they're buying to at what price. The price resets are not easy, and it's never been seen in venture for 15 years. Other than Flipkart's down round in 16 or so, and maybe Ola back then, there were very few companies which have taken massive down rounds. That's only happened in the last 2 years. And so we've not finished that cycle. And when that happens is when capital comes confidently and says that I'm willing to play at this price. So I think that will begin to happen towards the second half of 24. If you see early excitement or action or conversations in the first 2 months of 24, they've been amazingly at a peak. Because even if you look at the participation at the event today, you have overseas investors who haven't come here in 3 years, 4 years. So they're like, India is the new frontier market where we need to spend more time and invest into. So I think it'll get replaced. You won't get the same capital. You won't get a Tiger perhaps coming in as aggressively, but I think SoftBank is starting again. And you will have other pools in Asia are reorganizing themselves. So for example, if they had a China combined pool, now they have to separate the China pool so that the regulator and the Indian government is okay looking at a standalone India's dedicated pool. So all that reorganization has also taken time. So this is basically what I feel on the GP side, the investors who are making the bets. I think it'll be a strong year. I think it'll be a $10 billion year. Yeah. And at least I'm speaking for venture. Then, you know, private equity has been very robust, and they're actually taking the torch on capital raises. So from what I'm hearing, the best funds in India are getting oversubscribed. So committed capital will be at, I think on private equity will be at an all-time high this year for dedicated India funds. There's an interesting point I just heard on stage from Manish that Pan-Asian funds can also take off. So both put together, India is an important market for private equity, and they will take the lead out there. From venture, I think the big question on new committed capital is, are we returning enough capital? And that's been a 2-decade question now, right, almost. And so I think we need to get our act together and do a lot of that in the next 2-3 years. So unless we start churning out IPOs, because I don't expect M&As to be as strong in terms of cash outcomes. So the big cash will only come from IPOs. So I'm hoping that we get our act together in the next 24 months, push out a lot of IPOs, that generates cash. Like recently, I think Fireside had something from Mama Earth. Yeah, so these kind of outcomes where, you know, they're not small, they're not 10, 20 million, they're like 50 to 100 million, are important for the venture ecosystem to start seeing a lot more commits in.
Interesting, very, very interesting points there, Karthik. The second point I'd like to touch up upon is, as the chairperson of IBCA, you also advocate for a lot for the ecosystem and for venture capital. What are some of the active policy changes that you are advocating for? One of them you already mentioned, and I think Gift City is already sort of taking off. What are some more changes you want to see from the government end in terms of ease of doing business as well as for venture capital?
So I think they fall in 3 categories broadly. I think for us one has always been around how do we make the Indian capital industry more, to use the government slogan on this, more Atmanirbhar, right? So which means you have to mobilize and give confidence to all domestic capital, which is a very small proportion of capital that plays India today. So India still continues to be built even through our brands with FDI, right? It's not our capital, right? And so one is to therefore increase the proportion of Indian participation in these asset classes, which historically has been entirely skewed towards public. So whether, the insurance industry is finally okay to participate, and they're beginning to, but the units have to be a separate class of units so that there is no overseas exposure in them, for example. So that was a big, not a win, it was always there, but I think the clarifications and the ability to execute on that has gotten a tad easier. It's not like we've gotten hundreds of millions of dollars, but insurance is beginning to make a move. We're struggling to get that same buy-in in pension funds and provident funds, etc., in the country, which is a large pool of capital. So our institutional pools of capital in India are restricted. And the other ask we've always had is normalize capital gains, long-term capital gains tax between, at least if not across all private capital, and at least with AIFs. So that way the AIF industry organizes and pools more capital, and it looks legitimate then. You don't have to offer it to every private capital gain. But being out of sync with public market capital gains means that people always benchmark and compare that they have to pay 10% less elsewhere. So there is an argument around indexation reduces that, and we've heard those arguments. But it's much simpler, I think, if they can excuse the AIF industry's ability to get the same treatment as public market gains. Both of these are capital oriented. Second, this is inbound. How does money come in to the industry? Outbound is a big issue. So we are all beginning to realize that M&As are not easy. Like the CCI, for example, Competition Commission sat on the bill desk process transaction for a year. Transaction vanishes, price changes, right? So combination of how we make exits happen through ease of M&A, ease of listing are very important. And then from an ease of listing perspective, there was an argument that not all business models will be accepted by the Indian market, so we have to be able to list overseas. Yeah. And surprisingly, the Indian markets have accepted even the Zomatos and the Policy Bazaars and all of them, right? So thankfully, we have a whole line of companies, and SEBI has been very forthcoming in terms of allowing these guys to list. However, the optionality for a company which is domiciled in the US or Singapore for commercial reasons to again flip back to India is dramatically challenging. Yeah. Just not that, but doing that mid-course is a waste of resources, right? And especially if a long-term buyer is likely to be overseas, right? Why then come back here, right? So if theoretically a company like a Freshworks, not them, but say at a 500 million or a billion wants to get acquired, even post going public, then they should not be restricted to only listing in India, right? So GIFT City, all GIFT City directives are in that direction. So can we truly be a phenomenal replacement to Mauritius, and also facilitate, listing, banking, all 3 hours away from Bombay, which never used to be possible before, right? You had to take a cross-border flight. So can we bring and build that through GIFT City? And we're saying if you've built it, it's phenomenal policy to actually have an IFSC center in India, but then let's use it for the right reasons and not over-police it and to have too much domestic jurisdiction go there, which defeats the whole purpose. That's the second. The third is around ideas of, if you want certain industry sectors to explode, like insurance, for example, or asset managers, then we are trying to push for more FDI in those, which used to be restricted sectors in terms of ownership. So finally, today a PE house can own 100% of an AMC. So it allows for new acquisitions, new capital formation, new AMCs to be formed. So as the capital market is growing, you don't want that wealth and power to be concentrated in the current names. You want the industry to grow. And both IRDA, SEBI, all of RBI, they've all been proactive on this front. So we're hoping for more on that front. So these are the three directions in which we mostly push.
Karthik, has the fundamental sort of growth story changed? Maybe if we compare it with a decade ago, we're seeing, I think, the facade that India has a lot of TAM and paying subscribers. I think that has sort of been shattered. But has there been anything else that we're seeing compared to maybe 5 or 6, maybe a fund cycle length ago?
I'll have a different take on it. I don't think it's been shattered. Okay. I think it has been corrected to the extent that if you do not build delivery mechanisms which are at the affordability and price point of the average Indian, then you're restricted to your audience. Okay, so it's not like banks, the traditional banks, FMCGs, insurers have not thrived in this country. They have. And none of them have required venture money per se. They've required a lot of capital, but it hasn't been venture money needing to be thrown away. So I think the myth that because there's venture money and you throw money at the problem, you can grow faster is only partly accurate, and eventually it catches up with you, and profitability is not going to be achieved that way. But digital public infrastructure has become a huge anchor for India, which most other countries cannot boast of. So given that that infrastructure is virtually free to Indian startups and industry to be able to use, the cost of friction in identity, payments, tomorrow in transactional data and commerce, whether that's ONDC, it means that we build a very, very different ecosystem compared to China and the US, where we don't see these as profit pools, which was the original thinking, that can we make money on payments, that won't happen, right? But leveraging those to build more value add and using this advantage of really, really low cost access and data, having the cheapest data in the world. When you take all the trifecta of all of these infrastructural elements in India, we can actually, I think, start making a difference to more than 500 million people, right? And that is, I think, was unforeseen 6 years ago. Okay. So the reason it felt like a mirage was because none of what I just said existed till 2016. It's only been 7 years. Everything, right? So they were being built, but they were not, the on button didn't get switched on to any of them. So like the Geo network is being built for 5 years, but it didn't come online. So all buttons went green, and that's what's changed the trajectory, and I think where India can be by 2030. And then, of course, that will be the new foundation on which we build 2047.
Karthik, coming to Blume now, you've said that investors should showcase their returns as well. Can we talk a bit about how Blume is performing in that sense? And also, if you have any sort of new funds in the pipeline that you're raising?
So you've heard a speaker say DPI is the new MOIC. This is a different DPI. So in fund jargon, it's called distributions to paid in capital, which means how much money have we given back to how much they gave us. And MOIC was multiple on invested capital. So multiple is just a notional number because it's on paper. Yep. Distribution is hard cash. So the market has shifted to that. And we've had a good run in the last 2 years by facilitating like 5x cash back on our first fund. But it was very small. It was a $20 million fund. Now we manage 600 plus million. To return 3-4x on that is a lot of money. So we're nowhere close to that, right? We're somewhere between 100 and $200 million given back lifetime. We also not deployed 150, 200 million from the new corpuses. So it's a balancing act, right? And we're growing as a fund house. So we're not raising the small funds anymore. We're raising $250 plus million funds. So it takes time to deploy them and get them back. That said, we operate in approximately 3-year cycles. So this is our 3rd year. So we have a full year to go. So somewhere same time next year, if you ask me this question, I'll have a better answer on how Fund 5 is going. And that's our next fund. Right now, we have enough deployable capital for this year. So that's where Blume is at.